What is up, YouTube? This is the Working Investor. This video, we're going to talk about these new SEC filings. Well, maybe not too new, but maybe some updates were new for these new funds. They call it the trademarked, well, YieldMax is trademark, Target 12 trademark funds, which on first glance to the super high yield dividend ETF investor, 12% per annum does not seem too sexy. It doesn't get your eyes going to it. Because there are funds that pay a lot more than 12%. So on first glance, it didn't seem very appealing. But when you look into the details, and everything is in the details of the prospectus, I start seeing why there's a big appeal, and I definitely see a big use case. Just for perspective, I'm a retail investor. This is my interpretation, understanding of it. I'll drop you a link in my description for this SEC filing. You can go ahead and read the whole thing. And if something that I said is inaccurate, go ahead and let me know. Anyways, so these funds that are called the Target 12 funds are SOXY, which is a semiconductor, I guess Y for yield mass, so XOXY, BIOY, it's an easy way to think about it, so biotech and pharma. We'll talk about ZAPY. What a name, man. ZAPY. So it's like energy, option income ETF, and then RNTY. What a name. They come up with such good names, I gotta tell you. Their marketing is incredible. So that's the real estate or rental estate option income. Rental estate option income. And then they have QYQY, which is tech and innovation. And then this big 50, or big Y, BIGY. Big YieldMax. I'm trying to figure out what the big Y holding is, but let me go into some of the things that make this fund a little different. So of course, just go through expense ratio really quick, 0.99 expense ratio. And then when you go down here, I find when you scroll down and you go to the principal investment strategy, equity strategy, you see here where it says right here, I'll zoom into it, it's easier to see. It's the fund is generally unconstrained, basically meaning that it may invest in companies of any market capitalization size. So a lot of times, like if you have a bad company, like we've just seen recently with Super Microcomputer, which had a bunch of issues with the SEC because of I think it was like they weren't doing accurate bookkeeping or whatnot. So, you don't want to hold any dogs. So they're not constrained to pick or drop anything from what I understand. So they just, they have these like theme-based ETFs that have a 12% targeted return in dividends, plus they have equity, plus they want to have capital appreciation. I kind of glanced over it, but yeah, they still have their two primary and secondary objective. Honestly, I was hoping that because you're giving up a larger return in dividend yield, I've seen funds that have a co-important objective where there's two objectives and they're both equally as important, have the same weight. I was hoping that the growth and the dividends are equally weighted in level of importance, but it seems like the primary objective is to seek this income. The secondary objective is to seek the capital appreciation, via the investments. I was hoping that they will put more emphasis on that. But yeah, so one thing I wanted to point out is that they're not constrained. They're generally unconstrained. They could invest in any cap size. They also mentioned some jargon that it's not necessarily U.S. industry. Like if you're in the in the semiconductor, they can invest. I would imagine in Taiwan Semi. They're not like U.S. specific. And then so here we go. This is the gem over here. This is the crown jewel right here. When you go to option strategies, this is not what you think, which is your typical classical cover call ETF or synthetic cover call ETF. They talk about, it's almost like the lingo reminds me a lot of Ulti. Like it almost seems like a Ulti type of style of trading where they could do all kinds of, strategies that could favor whatever market condition. It's almost like a hedge fund within itself based on the type of strategies that they use, similar to Ulti. and but the target will be 12%, but hopefully they can get massive appreciation. But we'll have to see how these funds turn out. But look at the option strategies, really, guys. The fund seeks to generate income from engaging in option strategies, primarily using option contracts on some or all of its underlying securities. These strategies will be the primary driver of the fund's yield, which we understand with the 12% target annual target level, income level, right? That's what they call it, the annual 12% target. But they talk about they have all these different ways that they could pivot. And let's focus here like a few sentences, like a sentence in. The sub-advisor can implement the option strategies in various market conditions, depending on the sub-advisor's outlook. Zega, which I think Jay is part of Zega, or is the owner of Zega, will select one option strategy or a combination of options strategies that it believes will best provide the fund with current income, while generally also attempting to capture some upside appreciation. But, additionally, the sub-advisor considers the performance of the underlying securities. In some instances, the aim is to generate additional gains if the underlying security increases in value, while in other cases, the aim is to limit losses if the underlying security decreases in value. That sounds like a collar method or a whole myriad of different ways how they can mitigate losses. So they're to boost income and decrease losses. Further, depending on the sub-advisor's assessment of one or more of the underlying securities, option contracts, the fund may employ option strategies using the semiconductor. But here they're focusing just on semiconductor, so that's why you see a lot of lingo of semiconductor, because they're going. I guess they're going in order of SOXL and then so forth, so on and so forth. So here in the bottom line, it say the fund's use of option strategies with ETFs will always be covered. Example: the fund may do call or put spreads. And here's the big question. Are they holding the actual underlying fund itself, like the raw stocks, and writing options on it, or are they doing synthetics? So here they kind of provide some, for me, that provides some clarity that actually they do both. These strategies are applied consistently whether the underlying security or ETF is held directly or through synthetic exposure. There is no guarantee that the fund will achieve its targeted income from options or other sources in any given year. Well, they always want to have the disclaimer. This is the target, but they may fall short from the target. So don't go crazy. The fund will seek to meet the annual 12% target through payment of monthly income distributions. So I would imagine about 1% per month, which equals to 12% per year. This paragraph is really interesting because, again, a lot of times with these funds, with these cover call funds, you're very constrained with one type of strategy and you're constrained with one type of underlying. But here it seems like we said, it's not constrained to, it's a certain theme. You can have many underlyings that are in the same sector, so they can choose to trade a whole variety of different underlyings, and they can do a whole variety of different option trading. Look at this paragraph over here. The fund may be subject to different outcomes depending on the option strategies used. For example, when writing cover calls, the fund might limit its potential capital appreciation, which we understand. That's what cover call is, in exchange for premium. Alternatively, using option strategy such as cash secure put selling. So you see here, they're literally telling you that they have the potential to also write cash secure puts. They just kind of explain what they are. For those who don't know about options, selling put options while holding enough cash to purchase the underlying security if assigned. They're just spelling it out. But they can do cash secure puts, cover calls. They have a whole bunch of flexibility. The fund can earn premium income and potentially buy securities at lower prices. Well, these option strategies impact the risk-return profile of the fund, potentially affecting the volatility, income generation, upside capture, capital preservation. And this is the final paragraph over here. Additionally, the premium, there's much more, but this is like what I wanted to emphasize. The premiums of the fund received from selling options are directly influenced by market volatility, higher volatility, which is larger price swings. They just spell it out what it means. It typically results in higher premium. Therefore, the sub-advisor analyzes market conditions to determine the timing and type of option strategies to employ to achieve the primary objective of current income. By strategically entering and exiting option positions, the sub-advisor seeks to enhance the fund income potential. So this is not just like a robotic type of fund or a fund that's very like, very, very monotone. This is a fund that you give by purchasing these funds based on their prospectus that they're, again, and this prospectus, so you have to tell you, it's like, look at this. The U.S. Security Exchange Commission has not approved nor disapproved these securities or passed upon the accuracy or adequacy of this prospectus. So I don't want to misrepresent you. This is something they filed. It's still, either applied, passed or not passed. We have to just wait and see. But you're giving, these, hedge fund managers or, these option traders opportunity to use their skills and intuition and do their best they can to try to find, you get to have underlying of the exposure to the underlying with a 12% yield target. Hopefully they want to achieve that target if they can. But also you have these other opportunistic things that they could do to kind of mitigate downside protection. Because a lot of people buy funds, like value investors will buy funds, and then they want to buy like other funds that are like, to help offset, the correlation. So this way, if something tanks, something goes down, something goes up. So it's you're kind of hedging. So here, the fund in itself attempts to do somewhat of a hedge in itself, which is pretty cool. It kind of works with the market conditions. I mean, obviously, like, it's not perfect, and I would imagine that sometimes they may make the wrong calculation at the wrong time. The market does something that's unexpected. So there's always variables, and you have to speak to a financial advisor, if you're going to hedge or not hedge, if you have this fund or not. I'm not telling you one way or another. But it's really interesting. The way I look at these funds are, again, 12% target yield, which is awesome. And basically giving the fund managers a lot of wiggle room to do what they do best. Anyways, this is Working Investor over and out. We have to see how these funds turn out, and we'll take it one step at a time. All the best. Be well.